Hey everybody, Day Trader Rockstar here with you, and a great video again discussing our methodology and the HPS methodology that really is based off divergences and the quad rotation. The quad rotation is a key component of the methodology when we have multiple time frames that are aligning to give us the best opportunities in the market. Again, this is not a beginner video. This is a video that kind of goes into some of the more advanced features of the quad rotation. And if you want to learn more about it, you could always head over to daytradingradio.com, become a member there. I have a lot of my lesson plans and everything for members of Day Trading Radio. Also, we'll kind of just throw this out there. It is Black Friday, Cyber Monday sale, and I do have a sale going on until the end, Tuesday after Cyber Monday. So this is a great sale. Includes everything for life at Day Trading Radio, even new bots and scripts. Of course, you have the bots and the scripts and stuff, the methodology, the courses, the schools, all the alerts, the chat rooms, everything. It's just everything. And you get one 90-minute one-on-one coaching session right there. It's probably worth it alone, because that's basically me teaching you the methodology. So again, that goes on until Tuesday. Take advantage of that. Oh, the code is DTR 700. That's the code. It takes $700 off the price. Normally it's $1,700. It takes it all, brings it down to $999, $95, if you want to call it that. And then that's about it. So let's get on to this video. This is going to be an amazing video that's going to help a lot of traders. So when we typically, for me, when I'm typically trading the markets, we're looking at a time frame of a 1 minute time frame to a 5 minute time frame. We talk about the 1 minute, 3 minute, 5 minute time frames to trade as a day trader. All right, this is different from swing trading, which would be holding multiple days and multiple weeks, possibly. So we're talking really about what I call income trading, finding opportunities in the market to trade to make money. And everything is based off of business plan. And the business plan is to keep us organized, because we know what works. It's about getting to that point, getting those setups in front of us and taking those, executing on those setups. What are we going to do before, around those setups? If these setups work so well, and they do, and I'm actually going to add another tool to the puzzle today that's even going to, it's going to even prevent, let's say this. I always say this is a good example of what I say with this. A good divergence methodology, this divergence methodology with the quad rotation, will be 75 to 80% successful all the time. But there will be times when you don't get your profit that you expect. You'll get something, but it won't get there, and it might turn over. So there are going to be times when there's no definites. When I get into a trade, and again, if we were just taking an example here. Here's a let's take a look and see. Let's find a divergence here just to work with. Here, look at this beautiful divergence right here. Right there in this circle. Let me get my pen here out. And when we have that lower low, and this is what I'm always looking for. Again, if you know me, the first thing I want to do is just teach you the basics of trading. And the basics of trading is trend identification and how to identify a trend. And the reason we identify a trend, is because we're looking for a break of the trend. And the break of the trend is going to be the best spot in this on the chart to really be long. It's usually going from a downward trending market to an upward trending market, to a downward trending market, to an upward trending market. Once we're able to identify these little channels or trends, then we look for the pivots. And my job, is to identify these pivots, because these pivots are what we call divergences. And this is a change of momentum. And that's what divergences measure. If we go back to our original rules if we go back to the original mention of George, I always like bringing up this because there's always new people out there that don't know what stochastics do, and that measures momentum. And what happens with momentum is momentum will die out before the price of the stock will die out. similar to a rocket, engine pushing a rocket up. And if the rocket engine's died out, the rocket will continue to go up a little bit higher before rolling over. So we have the same concept in stochastics. When stochastics, in this case, that the buy side there is very easy to identify because you could visualize it going up. On the sell side might be a little more difficult, but the same thing. This is our stochastics. Our stochastics are measuring internal momentum in the trade. And the way the formula works, it's just comparing each candle to the previous candles and plotting it on a line from 0 to 100 represents a ratio where that stock or where that price is closing on the range of how many we're looking back on 9. So not to complicate any more, but when we start to see a change in momentum and the price continues lower, once momentum dies, the price will soon go with the momentum. So if the momentum died up here and moved down, then stock would come down. But if the momentum picked up here and actually turned higher, then the price would go higher. So this is a buy-side divergence. And this is a scientific, very logical area in the market that's very easy to spot. All right. And we use our multiple time frames on here because the better the setup, the more we're going to have that same setup on multiple time frames. We have the 9-3, 14-3, 44, and the 60-10. So we wait for this setup. This is as close as we're going to get to the holy grail right here. So what we kind of call a quad rotation, which you have a quad here. You have the quad rotation. That means everything made the lower low, and then you have a bounce. And then you have a divergence. So we call it a quad rotation divergence. And typically this is how it sets up. You get a quad, you get a slight bounce, you get a pullback, the price takes out. There's 3 ways this can happen. The price can maintain, the closing price can maintain at that line. The second low is going to be lower than the first low, all right, which is what we call a pure divergence. Or we could have a situation where both lows are equal. And that would be called a double bottom divergence. As long as there's a big difference between what the price is showing you and what the stochastics are showing you, that's going to give us the clue that momentum has shifted. So this is actually a nice divergence there. And from that point on, you take your entry, we place our stop under one tick underneath the divergence low, and you trade that. And and there's other things, a part of the puzzle which we're going to talk about today. And I know I do coaching so much that I get my feedback, and I remember the feedback, and where most traders have a trouble with the methodology or with the techniques and how to get in and how to get out and how far you're going to get with these, where do you take your profits on this? Very difficult, very hard to answer sometimes in the heat of battle. This is the heat of battle. Every market is different. It's not that you have a defined answer like, when do I take my profit? What's my standard? How many contracts? I could tell you how many contracts to get in, where to place your stop. But you have to see what the market is giving you at the time and what determine how far you want to take it and what type of divergences it is. Because as you can see, this ran up to the VWAP and then came right back down and actually took out the lows. And that's crazy. That's a crazy move. But we don't trade that way. We don't buy here and hold the rest of the day. Very rarely. Typically, we're getting our entry and we're getting our exit. And if we have the 60-10 on our side moving up, we tend to hold on to that position longer. But the guaranteed money, what I call the smart money, is seeing the divergence early, getting into the channel, getting inside the divergence, inside the channel, and taking this outside the channel, and then getting a pop and then starting to scale out. Now, again, the hardest part will be identifying where this is going to be. But for a rule of thumb, I use my 60-10 as a gauge, and we could actually take that trade up into that 60-10 is overbought, which would bring us right up, probably right around here. In that case, if we used our 60-minute time frame and we saw that, when we had that move up and we had the move, and this is turning, you got the move up at that point when you're taking first profits, you're also looking you're 60-10. If your 60-10 is up above 35 and pointing higher, most likely you're going to get that momentum going. If your stochastics and you get a signal and your stochastics are laying down and not getting that bounce, most likely when that 9-3 gets overbought, it's going to roll back over. So it's very, everything is taken care of for you, all right? It's just overthinking the stuff. Don't want to overthink things. You want to, first of all, this is what you want to concentrate on. And you want to concentrate on in such a way that you don't want to touch, you want to wear blinders. You really want to take this. The less time you're in the market, the less money you're going to lose. Believe me. Because the truth about that 90% of traders, 95% of day traders fail is true. It's just too emotional. You have to be too perfect, and you're not taught right. We have an emotional thing of we're going to chase a stock. It feels good to chase something, but that's when the market pulls back, and then you have the fear and emotion, and you get out and you get chopped up, and then you revenge trade, and then you overtrade, and then you feel like it doesn't matter. I'm just throwing it all in, and this happens a lot with people with prop accounts, especially. They think that these prop accounts are not. They're easily gambled away, and you shouldn't do that. You should treat that as a proper account, and you have to be perfect in everything you do. All right, I'm telling you, I could show you the best technique to trade, but unless you're in front of that trade, execute the trade and execute the exit. You can't just randomly be in the market and say, I'm just going to be here and I think we're going to break out here, and it ends up going against you. You have to have something that works in this market. All right. Most people will not, and if you think you do, well, then talk to me because I want to learn your style. No, I don't. This is the only thing that's going to work for you. Believe me. This will work really well as long as you have the discipline and patience. Now, I want to add something to it today. That's going to help you prevent you from taking losses. So, all right, you see your divergences, you get the recognizable channel. When you have your recognizable pullback in channels, you start to realize, all right, we have a quad rotation. I'll send that alert, quad rotation set up, start to look for that possible divergence. And that divergence happens if you get a bounce and come back. And that's our go-to holy grail trade. That's the best trade we have. But what if we don't have that? What if we have just a regular divergence or something a little bit different, not as pretty as that, pretty as that. Well, the same thing. At one point, because you might say here there's a little divergence, and you might have that low and that higher low, and you have that low and that higher low, and that might actually be a pretty decent little divergence there that you could take. And there's actually a small little channel here. So you could have these big channels, you could have, and it depends on what you have, but you could have the little divergences like that. Now I prefer to have my divergence, second stage divergence, that higher low above that 20 line. It's very important for me to do that. It shows better strength, but in some cases you don't have that, and you have to make that decision. But this is an example of what we're talking about. If it wasn't a pure divergence, or maybe you just thought maybe I want to get in it, and you get a divergence, and it was a good divergence, you're in it, and it gets a little pop-up here. But instead of here where you're getting, and again, this is on the NQ, by the way, this is on the NASDAQ. I think the NASDAQ's a great vehicle to trade. The MNQ, the micro NASDAQ, is even better, I think. But of course, you could use this. This will work on all strategies, on the ES, on gold, on Bitcoin, everything. So when you have your entry, remember you get your trigger here, and you get your entry, and you're starting to break out, and you get that fast rotation, and you're up here against the 80, and you're looking back here, and you're still under that 20 line. There's no real lift here. There's a little lift, but it's not aggressive up here. Remember, I kind of look at that 35 line. Once we start to get that momentum, it's much better. But if it's been pointing down and you're getting that little drift, and you're underneath the 200, you're underneath the VWAP, you're underneath the 20 and 50, and it's coming up to the 50, this is typically what we look for when we look for bear flag. So I'm already identifying this probably as a bear flag because of the fast rotation and the embedded 60 period here. And even though it went sideways, This is the smart money. So the divergence is the good money. Doesn't matter, but you have to take your trade off each and every time you get that 9-3 set up, unless you have a very strong 60-10 stochastic. Now, for those who made it to this part of the video, I want to give you something special here. Now, we're looking at the 1 minute. How do we make it easier? And I wanted to talk about this because I had another, I was talking to a trader the other day, and and a couple of traders I've been speaking to, they don't have the time I have to be in front of the markets. And that's a big issue. It's like, all right, John, I see what you're saying, but I'm not going to be in front of the market at 2 o'clock in the morning or whatever. But, if you're just happen to be, if this was something, a passion of yours, you would probably make it a point to identify, your perfect channels. And when you have a perfect channel like that and you have a perfect quad rotation like that, these are much better opportunities to trade. Even that this wasn't a divergence, you still have that opportunity. Lots of times we'll see a real recognizable channel with a perfect quad rotation, meaning they all come down real quickly and they pop. And this is things you'll develop over time to read. These are usually good entries. And again, when you take your entry on a quad rotation, you want to kind of get that one candle. You would like to have something to line up with the quad rotation, not just the quad, right? Like, because you could say, John, the quad rotation started maybe right about here, and it went down a little bit further. And if you get in here, where do you place your stop? And if I say you place it underneath the candle you got into, well, that wouldn't work at that point. So a quad rotation is not the perfect entry. You should have a quad rotation and a combination, what we call it, when we always talk about the 3-indicator methodology, where there has to be 3 indicators lining up, the quad rotation would be required as one indicator. This is considered one indicator, quad. Another indicator might be on a channel line. Another indicator might be a reversal candle. It might be also on a pivot area. So this had your main pivot. This had a reversal candle, and it had a quad rotation. So after that reversal candle would be our trigger, and probably get in on that. So important to know that. You don't just get in on a quad rotation. And the reason is, and this is going to be kind of important to you at this point, you will have a situation where the market is trending down, all right? And this is probably the worst scenario you'll run across. Because the market's coming down, you see the recognizable pattern. This looks very sloppy down here. This has been embedded down here, right? This has been embedded down here, but we're still always looking for that reversal. So we're like right here, low. I'd probably be measuring this out, and I'd see a low, and I'd see a lower low, and I'd see a low, and I'd see a higher low. And I say, uh-oh, we got a divergence there. Where do we take that? So we take it, and it never gets out of the channel. It comes up to the 20 and rolls right over here. It just kind of doesn't even make it up to the 80 to give you a chance to get out. It just rolls over. All right, it rolls over and continues to kind of move down. Now, not to say you're going to see that on the first time, but if you look back and you see that your stochastics were embedded here, that would be a warning sign for you. If this is heading up and this has continued to stay way underneath 20, in this case, it's down in the 10s, and anything down here, wherever that was, 7, 9, anything under 10 on this is extremely weak. And I try to talk to people and say, do not go against extremely strong or extremely weak market. Meaning that if it's above 90 here, do not short. If it's below 10 here, do not go long. But in some cases, you could say, well, I'm going to take that long there. And you might take that long, and you will get stopped out. And that should be it, because then you're going to realize, oh, I realized what I did. I went against this, and I got burnt. And once you get burnt once on an embedded stochastic, because first of all, you don't know it's going to be embedded until it fails the first time. And this could have been like a decent, and it moved up a little, but it didn't do anything. It's spectacular. We're not going to even call that, I'm not even going to call it. If it turned over, you got stopped out, But at that point, you could get running divergences. You could say, oh, here's another higher low here, and that's a little lower high here. But you cannot take that. You cannot take this until this 9-3 makes a full rotation up, meaning that we need to get a full rotation to reset everything, to kind of don't even let anything happen. Just forget about it. Forget about the trade, the downtrending market. If anything, you're looking at bear flags. You're looking for a fast rotation, this to stay down. There's plenty of trades in the day, so once you identify the embedded stochastic and you get stopped out once, and that could happen, that's okay. Part of business is business expenses. So if you're doing your business to identify these, get in and get out, there is going to be losses. So you bail on the whole thing, and you watch that and you say, all right, I want to wait until this kind of gets back up above the 80, and then we start to reset, meaning now I'm going to start to let everything come back, and now we have a quad rotation that starts to work. But if you have a downtrending market that's really embedded down here, do not go against the signal. That is such a big signal right there. That embedded stochastic. Same thing on the upside here. It's embedded to the upside. And, every time you pull back here, that's a bull flag. That's just a nice little bull flag. In this case, it's holding the 25th to 50 period moving average right there. Again, we're looking at the 60-10 on the bottom and the 9-3 basically. The other two we're not really paying that much attention to unless they're divergences. Here's a situation where you had this nice little move, and you have this little candle divergence there, and you start to move back up. And this is something typically I like, is when we have a upward move and a sideways type of channel. We're above the VWAP, we're above the 50, and we put a divergence in here with this embedded. That's usually our good flag. I like those flags. If we can get any type of divergence in a flag, whenever we have these little kind of drag, all right, this is kind of drifting sideways. I'm always looking for that divergence here. I'm measuring it out. I'm measuring this low, maybe, and then this actually very close to being a divergence, and not quite, but very close to it right there. All right, so here's now the bonus section here. Now we know how to kind of prevent that. Very important to prevent that. And again, very important to be ready to jump on this setup here. I mean, the majority of the time you have a divergence. You want to get that divergence, even if it failed on you. It's okay to be embedded. It's the first time it's embedded, and you get down there and you get a divergence and it fails, then you back off. If it's been embedded for a while, then you shouldn't go against it. You shouldn't try to kind of time that. It's like that's pretty hard to time. Let it rotate all the way back up, and then reset. We call it the reset. Now, this last thing we're going to talk about today is the importance of keeping this on. Like, this is the NASDAQ 1 minute. Now watch what happens. I'm actually going to bring this over on this chart here. All right, this is the NASDAQ 1 minute. This is on the NQ on the NinjaTrader platform. And again, you can see the beautiful channel, beautiful divergence, big move up. Kind of came back down, lower low. You see the 60-10 on this on the 1 minute time frame. Remember, this is so important. If you get a 60-10 and a 44 on a 5 minute time frame, and this is actually the 1 minute time frame, then we know we have the 5 minute divergence on the one. So this is at 9:36 on 7:20. Let's go. Sorry about that. Let's go to the 5 minute time frame. It's about 9:35 to 9:40. 9:35 to 9:40. We're going to be looking on the 9:3 on the 5 minute. 9:35 to 9:40. You're right here. So you see that low right there, and then how high this low is. These are very important. So this is how important that 5 minute time frame is. When you look at the 5 minute time frame and you see that big divergence, look at the move out of that. This is where you're going to get your monies made. This is where you're going to qualify in your prop accounts and stuff. This is where, and this happens a lot around the 9:30 open, big 5 minute divergences. They're worth taking. They're definitely worth taking. If they move back up, you have a nice 5 minute early in the morning. You have a lot of momentum behind that, and it really starts to move. And again, you could see something starting to appear here, and this is what I want to show you. Now, what if we say, all right, what can we learn here? This is using the quad rotation, but on a different time frame. This is the quad rotation on the 5 minute time frame. So we're going to zoom out here. And then what do we notice here? What am I noticing? All right. I have a quad rotation here on the 5 minute. Big move. Big move. Let's circle that because we like that. All right. Then we have over here a quad rotation. And a quad on a 5 minute is not going to happen like we have it on a 1 minute time frame. Look what time it is here. It's 8 o'clock at night, and then like at 3 o'clock in the morning. So again, not that you're going to be in front of this all the time. And then we had one, I would say, right here. And remember, this is a 5 minute time frame. 5 minute time frame. If we just call that right there, 5 minute time frame, that one up 5, 10, 15, almost 20 minute move up. And again, this is the MNQ, so it's much bigger moves. And then I see one more here. And we'll be real, again, for me, you gotta call as you see it. Now this, right here. That was a good one too. That was a really good one right there. As you can see, these bounce back up. So you had a bounce here, and then it dropped back down, and then you had another quad rotation. Probably, right in that area. And then you had that bigger divergence here. Now, when we get into that rotation zone on the 5 minute, we're very close to big moves. So always refer back to this. And kind of, if you want to just be in the market at levels that you want to get these bigger trades, then you have to actually just wait for that quad rotation on the 5 minute time frame. Let's go back a little further. Now this didn't give us a full rotation, and this might be the problem. The problem is it's a long time to get us all oversold. This one actually chopped down a little bit further. This was when we talk about the embedded stochastics, and this will probably be the dangerous part of this, is because it takes a longer amount of time to show up. It takes 5 minutes per candle. So you don't want to be really, stuck in a trade like this. But the concept here is to understand when you have a better chance of a bigger move. Now, if you really zoom out on these and kind of just look at each point we get down there, you'll see big move there. I'm just looking at the 60-10. Basically, I'm just looking at the 60-10 when it gets under there. Big move there. It hits the 60-10. Big move there. Underneath the 60-10. Now, again, it's choppy here, but a decent move there. Same thing. Decent little 5 minute move there. Now, this was probably a little choppy here, but overall, when we look at maybe looking out 10 minutes from the entry, most likely you'll be in a positive trade. Meaning, if you got into down here and you kind of just waited it out, the odds are you're probably going to get that lift on there. So always keep an eye on that 5 minute band down there. This is on the 5 minute chart, but the 60-10 on that. The 60-10 chart on this. Let's see. If I could pull this over a little bit further. And then we have here, right here, big move there. And you might even want to wait for that turn back up. There's that kind of that cross back up above the above that 20 line, pushing back up. Get that momentum started. Because you will have, again, 5 minute candles. A lot of time here. A lot of time to be in these trades. Big move up. This one just tagged it, started turning back up. Huge move up. Decent move up. huge move up. Huge move up eventually. All of them. All of them. It's very rare that you get really stuck in anything here. So always keep that 5-minute rotation handy because that's a good confirmation for you. You know, if you start to see that on your side and you want to know how long am I want to take this off, and that goes back to the hardest questions. Easy enough to get into these trades. The hard part is getting out of them. So let's take a look at the, go back here to the 1 minute time frame. As you can see, our 60-10 on the 1 minute does a good job of identifying those 5-minute oversold levels. Let me move this all the way over here just to kind of give you a feel of what I'm looking at here. All right. Right there. I'm just gonna circle this here fast because I want to measure that out. I want to zoom in here on this too. Because you might actually say, you know, this wasn't a quad rotation, but it was a. Let me see where we are here. Not oversold, not oversold. I'm looking for that rotate. Oh, here. Maybe this low to this low, to this low to this low here, might have been considered a divergence there. But at that point, we were oversold. We were pointing down on the 60-10. We were not in a quad rotation divergence. Once we got into that quad rotation, and then we held up, and we had that divergence now, then you had, you know, the much bigger move. There was a little chop there. Just want to make sure you understand that. Quad rotations, divergences, they work great together, you know, but it's important to have that good, pure quad rotation. And if it goes against you, in the case of a downtrending market, you know, which I don't see here, maybe here, even though this was a little divergence here, and I would have taken that, even though that's, you know, I would have taken that, and that's on the 1 minute time frame. You're going to see that early. You're going to see that nice little candle. Should be in it here. That's at 2052. I'd end up going to 62, 10 points on the NASDAQ. Not much, but look where that 10 point brought you. It brought you overbought right on the 9.3, and it told you, you know, right when we get up above that level, it did pull back. So and if we look at the 60-10, they were pointing down. Wasn't giving us anything on this. So you gotta be able to take your trades off the table when you have that signal. Now we try to surround you with all the signals, meaning divergence. You get in your 9.3 stochastics if they're embedded. Be careful. Get out on your first rotation. If they're not embedded and working in your favor, then you use the 60-10 as a help to kind of time your exits. Always keep an eye on that 5 minute time frame. When that 5 minute time frame lines up, you probably have a better bottom being put in, better bottom being put in, better bottoms being put in here. You know, these little things that you write down and you just focus on. This is where you want to be in. This is where you want to be in. This is where you want to be in for the bigger trades. Now, there's a lot. I was jumping all over the place on that video. I just wanted to get the point across that you know, pay attention to your 5 minutes. It's going to help you with your exits, help you with your entries, and keeping you out of the market most of the time. If you just kind of focus on it, and again, this is on the 5 minute time frame on the NASDAQ. It works just as good on the ES. Bringing us on the MES here. Look at that. Even in some cases, you're going to have better charts on some. Sometimes you're going to have better charts on. But that's the holy grail right here. Oh, look at that. This is a 5-minute time frame. It just, I'm always searching for this. That's the setup here. 5-minute setup on the 9-3-14-3 with a quad rotation on the 5-minute. I mean, that's a 5-minute divergence is usually the best setup we go for in a downward channel here. And that's 3 o'clock in the morning. That's European Open. I always tell there's some good divergence to be had at 3 o'clock in the morning. Here's another 5-minute divergence on the MES. Nice one too. That was at 8 what is that? 8 o'clock. 8 o'clock. Good divergence right there. Perfect. High level divergence on the 9-3 plus a quad rotation on the 9-3. So if you get a divergence on the 5-minute and your rotation on the 60s down here, it's go, boy. It's go. Look at that. I didn't realize that this was so important. That was a good divergence on the 5-minute. Great divergence on the 5-minute. In both of these cases, you were oversold. It was really a quad rotation 5-minute divergence. I mean, it doesn't get any better than that. Does not. And here it is again. Wow, this is kind of a random thing. 3 big divergences on the MES. Wow, on the 5-minute. We got to start paying attention to that a little bit more. We really do. Watch for that 5-minute. Have the real estate. Once you get that 5-minute divergence set up, you should be good to go. Here it is again. Oh my God. Forget it. Hold. Double bottom, high rotation, quad rotation. High rotation, quad rotation. Came off of quad rotation, then it'll have a divergence. Just like we talked about, the first part of the video is a 1-minute quad rotation divergence. The 5-minute is absolutely devastating. Absolutely devastating here. Now, that looks like I have to make a script for this. All right. Some of these are just quad rotations, but when you have that quad rotation divergence, that's a change of momentum. That's everything that we wait for. That's everything that we want. Wow, really impressed. All right. Always searching. All right, we're going to leave that video as it is. Hope you had a good one. If you want to take advantage of the lifetime, you have until Tuesday, $700 off, DTR 700. If you need to get in touch with me, ironaction@yahoo.com, ironaction@yahoo.com. Of course, the lifetime comes with that one-on-one, 90-minute one-on-one session that you could use any way you want. We could trade together. We could teach, I could teach you the methodology, set up your charts, everything. That's really a good feature of the lifetime membership. Plus, it gives you some other great membership. You get all the scripts and all the new ones. Like I said, I have a couple new ones that we're going to be releasing soon. You get those. Here's again, write down your rules. Make sure you have a couple different type of divergences. You have that low and that lower low closing price and the higher low. And it's a quad. And that's where your entry. That's the only reason you have that there. That higher rotation above the 20. Quad rotation, big move up on the 5-minute. But again, here's at 3 o'clock. The other one happens the next day at 1 o'clock. The next one happens at 8 o'clock at night. It's like 5-6 hours between a great setup. That's very hard to do. But if you had those setups delivered to you, then we're talking cash money. So look for those to be delivered as much as I can. Wow, here it is again. I mean, it doesn't stop. That wasn't a quad, but it was a divergence. Nice going. All right, that's it. Let me get back to the watch list. We have a watch list coming out. That's right. Every week we put out the HPS watch list for stocks. These are stocks that are set up as we teach when we trade stochastics, or when we trade futures and day trading, but we also apply these rules for swing trading for quality names and stocks. So that's coming up next. I'll see you in the markets tomorrow. Have a great weekend.